What's up traders, welcome back to the channel. Today we're diving into one of the strongest AI winners of the year, Palantir Technologies. This stock is already up around 130% in 2025, and naturally everyone is asking the same question. Vikram, where do you see Palantir's stock price by the end of 2026? So in this video I'm breaking down the answer with real numbers, real logic and a clean scenario based framework. No hype, no moonboy predictions, and definitely no emotional assumptions, just data, clarity, and professional grade analysis. Here's what we're about to cover: the actual earnings estimates for Palantir, why its valuation is the biggest double edged sword in the entire AI sector, how different forward PE compression scenarios impact the price, what the bull case looks like, what the bear case looks like, and finally, my personal price range for Palantir heading into 2026. Let's get straight into it. To make a price forecast for 2026, we need two major inputs. The first one is Palantir's expected earnings per share for 2027. Analysts project that Palantir will earn $1.40 per share in 2027. That number is extremely important because it allows us to reverse engineer what the stock price should be depending on how the market chooses to value the company. The second input is Palantir's forward price to earnings ratio. Right now, Palantir trades at a forward PE of around 189. That's already down from over 250 earlier this year. And when it hit that level, I said repeatedly that it was unsustainable. For context, the average stock in the S&P 500 trades near 20 times earnings. Palantir was trading at more than 10 times the market's valuation. So the compression from 250 to 189 is natural and in my opinion will continue into 2026. Now let's talk about the scenario analysis. This is where everything comes together. We will keep earnings per share at $1.40 because that's the consensus, and then see what happens to Palantir's stock price if the PE ratio compresses to different levels. Scenario 1: if Palantir somehow maintains its current forward PE of 189, then the share price could rise to around $265 by the end of next year. But this is by far the least likely scenario. The valuation is simply too high for the market to sustain during a maturing AI cycle. Scenario 2: if the forward PE drops to 150, the expected share price becomes roughly $210. This is still bullish, still optimistic, and still assumes that Palantir's execution remains flawless. Scenario 3: if the PE falls to 125, the stock price would land near $175, meaning the stock would basically be flat to slightly higher from today's levels. Scenario 4: if the PE compresses to 100, then the stock price could fall to around $140. This isn't bearish. In fact, a PE of 100 for a hyper growth AI company is still premium, just less extreme. These four scenarios give us a realistic range of outcomes. And now that the numbers are clear, let's talk about the business itself, because this is where Palantir really shines. Palantir's execution over the last couple of years has been phenomenal. Revenue growth is not just strong, it's accelerating. Profit margins have been expanding quarter after quarter. Cash flow from operations is impressive and consistent. The balance sheet is pristine. And the company is winning major deals not only with government clients but also with a rapidly increasing list of enterprise customers. Their backlog is growing and their commercial platform is finally scaling in a meaningful way. This business absolutely deserves a premium valuation. Not many companies have a moat like Palantir. Very few AI companies can operate at this level of scale and deliver mission critical solutions with this level of reliability. There is no real number 2 competitor close behind them. Palantir is far ahead. But here's the other side of the story, and this part is extremely important. When a company performs at an elite level for 6, 8, even 12 quarters in a row, the market begins to expect perfection, not strength, not outperformance, but perfection. And when valuations reach nosebleed levels, one minor hiccup in revenue growth, one small drop in margins, one slight slowdown in customer onboarding, and the stock can drop 20, 30, even 40% very quickly. Meanwhile, if Palantir delivers another excellent quarter, the upside is limited because perfection is already priced in. Let me give you an example. Palantir recently announced phenomenal results, revenue growing around 60%, expanding profitability, strong guidance, and yet the stock price dropped afterward. Why? Because the valuation was so elevated that even excellent results couldn't support the premium. To push the stock significantly higher, Palantir would have needed to report something insane like 80 or even 100% revenue growth. At their scale, that is nearly impossible. This is the definition of valuation risk. So now let's move to the final part. Where do I think Palantir stock will realistically end up by the end of 2026, taking into account valuation compression, taking into account the $1.40 EPS estimate, factoring in the company's incredible execution, and also recognizing the limitations of premium pricing? My realistic range for Palantir stock by the end of 2026 is between $175 and $200 per share. There is still some upside, but the risk to reward ratio is not ideal because the downside is significantly larger if Palantir misses even slightly on expectations. And I want to make something very clear here. This is not a sell rating, this is not negativity, this is simply acknowledging that the stock has run incredibly far, incredibly fast, and the valuation premium is already fully loaded. Palantir is a phenomenal business, their execution is world class, and I believe they will continue to dominate in both government AI and enterprise AI. But that doesn't automatically mean the stock is a screaming buy at every price. Right now, the business is excellent, but the valuation makes the entry point risky. That's why my stance is simple. Palantir is a great company, but at these prices, it is a cautious hold, not an aggressive buy. If you already own shares and you're in it for the long run, you're holding a high quality business. If you're planning to enter, wait for a more reasonable valuation or a correction. Palantir is volatile enough that it will give you opportunities. Patience is your advantage. That's my complete breakdown. If this analysis brought you clarity, hit the like button, drop your thoughts in the comments, and subscribe for more data driven breakdowns every single day. This is Vikram Singh. Stay disciplined, stay sharp, and never invest emotionally. Peace.